morning, MacroAmerica. Today we'll be discussing our country's macroeconomic fate.
Hello, I'm Sam, Senior Director of Monetary Analytics here at MacroAmerica. As we know, the Federal Reserve is the central banking system of America, and without it, we'd all be chopped liver. Let's take a walk down memory lane, shall we? The Fed was created on December 23, 1913, with the enactment of the Federal Reserve Act in response to a series of financial panics, especially the Panic of 1907. This panic occurred over 3 weeks when the New York Stock Exchange fell almost 50% from its peak the previous year. Since this was a time of economic recession, there were many runs on banks and trust companies. Runs were when people got scared of their bank closing and would take their money out of it before this could happen. With banks only holding a small amount of money compared to the amount of money they lent out, there was not enough money in the bank to give everyone their money back. This quickened the closing of banks and was a very bad situation. Bank runs are named this because the bank customers would strap on some Skechers and literally run those chicken legs down in their bank just to save their money. The good old Fed system was created to prevent disasters like this from happening again. Also, back then, people were super lazy and they wanted to avoid running AMAP as much as possible. When the Federal Reserve Act was amended by Congress in 1977, a dual mandate was created in order to promote maximum sustainable employment and price stability. Price stability is usually interpreted as low and stable inflation. Oh nuts! Looks like we have some breaking news. Let's head back to Izzy.
As we all know, the Federal Reserve, or what is known as the central bank, has raised interest rates for the first time since the financial crisis in 2008, taking baby steps and letting the economy go off on its own. But could it be growing too fast? What you see here is the business cycle graph showing real gross domestic product versus time, showing how well or poorly an economy is doing. Right now, the U.S. has been said to be in recovery, which may seem like a good thing, however, inflation rates have been increasing. Many say that because of this, the economy is currently experiencing an inflationary gap, as shown above. The inflationary gap you see here is caused by a rise in the level of an economy's GDP, which then causes an increase in consumption, leading to higher prices. To counteract this, contractionary monetary policy must be implemented. Contractionary monetary policy is a form of economic policy used to fight inflation, which involves decreasing the money supply in order to increase the cost of borrowing, which in turn decreases GDP and dampens inflation. When the economy is under inflationary pressures, the central bank, or Federal Reserve, decreases the money supply by either increase in the discount rate, or sale of government bonds, or increase in the required reserve ratio, or by carrying out all of the changes simultaneously.
The United States economy grew at a better pace than expected using the process of quantitative easing, where the Federal Reserve pumped money into the economy to spur growth. The unemployment rate is currently about 5%. Officials observe that unemployment has continued to fall and job growth has been steady with a decrease in jobless claims. Recently, there has been an increase in automotive sales and new home construction, both revealing that Americans have money to buy large ticket items. In addition, with the decline in gas prices, Americans have additional money to spend, increasing consumer spending. This has contributed to an increase in real GDP, shifting the aggregate demand curve to the right. The CPI is about 238, which is fairly high, showing the prices paid by consumers has increased. The increased consumption has led to a price increase, proving that inflation has been increasing and the United States economy has entered an inflationary gap. It is time for the Fed to tighten and rein in spending, slowly decreasing the money supply and raising interest rates to prevent runaway inflation.
In order to push ourselves out of an inflationary period, we need to decrease the money supply through open market operations. By selling government securities, the money supply will decrease in small increments. Therefore, we need to see a shift to the left of the money supply line. Also, interest rates should be increased in order to decrease consumption, investment, and net exports to further push us towards equilibrium.
Hello, I'm Myles Shipe, Senior Director of Financial Analytics and newscaster here at MacroAmerica, alongside my fellow co-anchor Michael.
Good morning, I'm Michael Paino, Senior Macroeconomist and co-anchor here at MacroAmerica. In this week's business news, we have a lot going on. Changes in the macroeconomy happen marginally, every day. However, all of us economists are talking about one thing, the raising of interest rates by the Federal Reserve. This past December, Janet Yellen came to her long-anticipated press conference. We will take you there directly.
Good afternoon. Earlier today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 1/4 to 1/2%. This action marks the end of an extraordinary 7-year period during which the federal funds rate was held near zero to support the recovery of the economy from the worst financial crisis and recession since the Great Depression.
That's right, ladies and gentlemen. After 7 years of no interest rates, the Fed has finally raised them. Now, what does this mean to regular people like us?
We here at MacroAmerica, along with our affiliates, have crunched the numbers and deemed that it will have a lot of effects on us. Our affiliate Jill Gonzalez at WalletHub.com told us credit card rates tend to follow Fed moves almost immediately. Expect to see a higher rate on your card in 1 or 2 billing cycles.
Did you hear that? For those of you who owe a lot on your cards, pay it. You'll be stuck paying for more than you spend, and no one wants to do that.
Another friend of us here at MacroAmerica is Greg McBride, the chief financial analyst at Bankrate.com, and an expert on cash deposits. He says most savings accounts pay a fraction of a percent in interest, and that's unlikely to change soon. Banks don't need to attract more deposits. After years of earning low returns on loans, banks are more likely to raise rates on loans first, not on deposits.
With that being said, continue to save your money. Here at MacroAmerica, we are a news company filled with various millennials, myself included, my co-anchor Myles, Sam, Ariana, Cierra, and Izzy. Many of our employees are recently college graduates, and with our Millennials in Macro program, we have a plethora of internships available to college students.
That's right, Michael. College can be scary, and paying for college can be even worse. Our resident student loans expert, Mark Kantrowitz, says if you have a federal student loan, breathe easy. Your interest rate is fixed and will not change. However, with private student loans, your rate will go up within the next billing cycle or so if you have a variable rate loan, which about half of borrowers do. Just as the trend before, don't worry. Just keep paying your debts down. It isn't big enough of an increase on the interest rates to make a significant difference yet.
And finally, for all you homeowners out there, interest rates are scary for you as well. Carolyn Bidja from Chicago Tribune says, as with student loans, if you have a fixed rate mortgage, you don't have to worry about higher monthly payments. A borrower with an adjustable rate mortgage will see payments increase almost immediately if beyond the temporary fixed rate period, usually the first 5 to 7 years of the loan. If you plan to stay in your house for several years, now may be the time to refinance into a fixed rate loan.
Of all the people we have talked to about the changes made by Ms. Yellen and the rest of the Federal Open Market Committee, Carolyn Bidja has told us that home loans are the one you need to change your outlook on. The rates will certainly change, and to save yourself money, you may want to refinance your home loan, as to avoid the heightened payments you will pay otherwise.
All right, that is all from us today here at MacroAmerica's Business News.
Okay. Thanks for tuning in. We hope you enjoyed today's broadcast from us here at MacroAmerica. And remember, give the Fed its credit.
When I ain't had no money, I still had sauce. So if you don't got no sauce, then you're lost. But you can also get lost in the sauce.